Welcome back to our channel, where we explore the world of finance, investment, and business. In today's video, we will be showcasing 10 powerful charts that demonstrate the incredible potential of long-term investing in stocks.
1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm. Pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
Continue watching as we take a journey through time to understand the long-term performance of this iconic benchmark. When it comes to building wealth, Americans identified real estate as their top way to build wealth, with 41% preferring real estate over stocks. One might argue that by exclusively investing in the hottest real estate markets, such as the Bay Area, during opportune periods in the 1990s, real estate could potentially outperform the returns of S&P 500 stocks. You might be surprised by data. The data clearly illustrates that the growth of S&P 500 stocks far outpaced the rates of all the lines below, each representing a thriving real estate market. Remarkably, the S&P 500 stocks even surpassed the surge in Bay Area prices, where housing prices soared due to the tech boom. To put the S&P 500's performance into perspective, let's compare it to other asset classes. Historically, the stock market has delivered average annual returns ranging from 7 to 10%, while bond returns have averaged around 2 to 5% annually. Average annual returns for real estate investments have ranged from 5 to 7%, accounting for rental income and property value appreciation. Let's zoom in and examine how the S&P 500 has performed in each decade throughout its history. The 1970s, marked with high inflation and economic uncertainty, delivered an average annual return of close to 2%. Fast forward to the 1980s, a decade marked by the rise of the technology sector, S&P experienced an impressive average annual return of 13%. The 1990s, known as the dot-com era, brought substantial excitement to investors with an average annual return of almost 15%. The 2000s were characterized by several significant events, including the bursting of the dot-com bubble and the global financial crisis. The S&P 500 delivered a negative annualized total return of -0.9% during this timeframe, marking only the second occurrence of a decade-long period with negative overall returns in the market's history. While bear markets can be unsettling, it's important to remember that they are part of the natural market cycle. Some notable bear markets include the one in 1973 to 1974, fueled by the oil crisis and rising inflation. In more recent times, we had the dot-com bubble burst in the early 2000s, triggered by overvaluation of internet-based companies, and the global financial crisis of 2008, caused by the subprime mortgage crisis. Recovering from a bear market, the S&P 500 often enters a new bull market, providing opportunities for investors to earn significant gains. As you see, 60% of investment portfolios managed to beat index during the bear phase, as compared just under 30% during the bull market. Over the long term, small caps outperform large caps. While small cap stocks have the potential for higher returns, they also come with increased volatility. Technology stocks have significantly outperformed the index. With a return of 38 times initial investment, Netflix took the top spot, followed by Amazon and Apple. However, it's important to acknowledge that even in the tech sector, periods of extreme volatility can occur. In the early 2000s, during the dot-com bubble burst, Amazon stock experienced a massive dip, dropping by almost 70%. Investors who held on to high-quality tech stocks through the crash eventually saw their investments recover and flourish. The S&P 500 and the Nasdaq exhibit notable similarities in returns, driven by overlapping stocks and the influence of the technology sector. These charts provide a glimpse into the fascinating world of wealth creation through the U.S. stock market. Don't forget to subscribe to our channel and share this video with others. Stay tuned for more captivating content.